here we are on Monday, and I won't know until tomorrow or later tonight what has precipitated this last pullback. We'll talk about last week's pullback in a moment and some of the things that I found interesting about it. But I mean, look, first and foremost, the long-term case for gold and silver is crystal clear, as far as I'm concerned. You have central banks, foreign governments will continue to buy gold and silver now, unless there is a fundamental change in the attitude of this country, in particular Congress, towards the U.S. budget deficit and the nonstop continued deterioration in our fiscal condition and our fiscal sanity. Our fiscal irresponsibility is off the charts. And you can see that by the continued shutdown of the government. And I think there'll be volatility. Look, this is a game where, largely because a lot of things that we've been talking about since 2020, when I started talking to you about the deliveries that we saw, those were the beginning signs of a system that is all about paper promises, rehypothecated paper promises coming unraveled, where countries and sovereign wealth funds and very plugged in individuals and groups realize that it is indeed the Achilles heel of the entire system. And they would rather, I think, slowly exploit the metal and the commodities out of the system before there is a mad dash for them. And you know, a lot of people in this country, instant gratification isn't fast enough, and we've seen that with the rise and proliferation of cryptocurrencies and stocks like Nvidia and Apple that have defied gravity. One would say, well, why don't they just come in and buy it all up? And because you would see the strains that we're seeing right now in the LBMA, you would have seen them blow up instantly. And so this is something that is not only coordinated, but also methodical, very well thought out, and done so little by little. But I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice. But what we have been seeing is deliveries, like in gold, that are 93% higher for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the Commitment of Traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period. And so, in essence, what we saw in my mind last week was driving down the paper price and immediately delivering contracts for the current month. They would drive down the December paper price, the futures, and stand for delivery an immediate contract in October. So what was interesting to me about it as well was some of I think it's Michael Lynch, I think is his name, I'm pretty sure. Sorry, Michael, if I got that wrong, but I think that's who it is. And he writes a report dealing with COMEX, and he talked about the footprints that he saw, that the two entities that, first of all, on, I want to say Wednesday or Thursday night, the price was driven down after New York had closed. And it was driven down in between New York and China, Asia, where there's virtually no liquidity, where no rational trader would ever dump metal, copious amounts, all at once into a very thinly illiquid thinly traded illiquid market, period. No one would ever do that. They did. And it's done for effect, specifically for effect, to drive down the price, to guarantee the absolute worst settlement, the way that it should have been done. And when the mainstream talks about this, they neglect to tell you, well, by the way, it was all dumped in the middle of the night, or, after New York trading. That would change the outcome. I think it invalidates the valid reasons. It was done for effect, not the way that it should have been done over hours or days, bled through New York where there's great liquidity to ensure the best settlement. Anyways, what I found interesting was he talked about the two big buyers that came in and drove silver price up into the green after being down $1, and gold about halfway up, because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional, and if levels are breached, they just sell. So selling begets selling begets selling. But I found it interesting that he notes that both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. Now, the reason I think it's interesting is we've talked about Michael Hartnett and for the lead analyst for Bank of America that has the big high-price newsletter. I think it's north of $10,000 a year for institutional traders, and also the chief investment officer of Morgan Stanley have been in the news lately, where Stanley says no longer 60-40, 60 stock, 40 bonds, it's 60-20-20. Sell half your bonds, buy gold. And Hartnett says, no, it should be 25, 25, 25, 25, stocks, bonds, short-term treasury, and gold. And so here you have two very large commercial banks. And by the way, Morgan Stanley has been a huge seller of gold leading up to this, and all of a sudden they come in and buy over 600,000 ounces. Where you have these big banks who never talked about gold at all, any allocation, now saying as much as 25%. This was done for effect. And it was done either to cover shorts, to take possession of physical, or to rattle the bushes and make people think all of the things that the mainstream said, a lot of which were valid. Gone up 9 straight weeks in a row, was overbought, in need of some sort of a flush. Okay, I believe all of that. And if it had been done properly, the right way, over time, instead of all at once, when the market was liquid instead of when it was illiquid, well, maybe I'd believe that.
Here we are again on a Monday, and by the time you're watching this, I still may not even know what triggered this latest pullback in gold and silver. Maybe it's geopolitical, maybe it's an algorithmic washout, or maybe it's the same old Wall Street playbook that's been running since the COMEX was invented. What I do know for sure is this: the long-term case for gold and silver has never been clearer. We are watching the slow, grinding collapse of fiscal sanity in the United States, and the rest of the world knows it. Let's be honest, our government can't even keep its lights on without drama. Every few months we're talking about a government shutdown, and yet not a single politician ever mentions cutting spending in any meaningful way. Washington's fiscal irresponsibility isn't just bad, it's apocalyptic. You can't run trillion-dollar deficits during peacetime and expect your currency to hold value. The deficit isn't just a number, it's a signal of moral rot, and that rot is now visible to the world. And while Congress argues over how to fund 1 month of spending, the central banks of the world are quietly buying real money. Not treasuries, not dollars, gold. Look at the numbers. Central banks bought more gold in the past 2 years than at any point in modern history. Nations like China, Poland, Turkey, and even Singapore are hoarding metal hand over fist. Why? Because they see what's coming. The unraveling of a system built entirely on paper promises. A system where assets are hypothecated, rehypothecated, and leveraged until there's not an ounce of real collateral left behind the curtain. That unraveling started years ago, back in 2020, when we began to see strange footprints in the COMEX delivery data. Remember that? Back then, I told you we were seeing the beginning of a structural stress event, massive physical deliveries, sovereign buyers showing up quietly, and a slow drain of physical inventory from the LBMA vaults. And here we are now, years later, watching the same pattern accelerate. Just in October alone, and we're not even through the month, Almost 39 million ounces of silver have been delivered on the COMEX. Let that sink in. 39 million ounces. And this isn't speculative paper trading. These are issued and stopped contracts, meaning physical delivery is being taken. Whether those bars leave the COMEX or not is secondary. The point is, someone is standing for metal. And that number, triple the usual posted figure from the first day notice period, tells you this is not normal. What's happening is simple. Big money on sovereigns, banks, ultra-high net worth individuals are converting paper into metal. They're doing it quietly, systematically, methodically. They're exploiting the paper system before the mad dash begins. Because when the rush comes, it'll be too late. You see, people always ask, Andy, if these countries know the dollar's dying, why don't they just come in and buy all the gold and silver right now? Well, because if they did, the system would blow up instantly. The supply stress we're seeing in the LBMA and COMEX would go nuclear overnight. Prices would skyrocket, delivery would fail, and trust in the entire global paper market would collapse. So instead, they move slowly. Death by 1,000 small withdrawals. But every once in a while, we catch a glimpse of the operation, like last week. Between October 17th and October 20th, just 3 trading days, 6,000 contracts for immediate physical delivery in gold were written. Each day was a new record for this stage of the delivery period. Let that sink in. While the paper price was being smashed lower, massive physical orders were being filled. That's not random. That's deliberate accumulation. And here's what's fascinating. When the price gets driven down like that, it's never during New York's active hours. Never. No rational trader would dump huge volumes of contracts into a thinly traded, illiquid market between New York's close and Asia's open, unless they wanted to crash the price. That's exactly what happened. Massive sell orders were dropped into the void between trading sessions, driving gold and silver down in seconds. And then, as soon as the paper price was crushed, we saw a flood of immediate delivery orders, physical metal changing hands.
Well, you can see the reaction by doing it the other way, dumping it, the reaction that it has. It's, oh my gosh. And to your point of fiscal irresponsibility, the U.S. government added $1 trillion to the debt in 71 days last month. 71 days from 37 to 38 trillion just recently. And the interest cost on the debt is mounting at a level where, it's now the largest budget item. And none of this includes the unfunded future liabilities, which are so large and disgusting that I don't know how you pay them off without devaluing the currency. Ultimately, that is how it has to be done, as far as I am concerned. But yeah, this is a deal where the shipments out of both the COMEX in New York, or the shipments into COMEX in New York or out of, some of it stayed in there, roughly 38 million ounces this month of silver, and that will put it on pace to be one of the biggest delivery months ever. This is a deal where, at the same time, you have one of the largest short positions ever on SLV. Over 80 million shares are naked short. To affect this, there's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever, and at the same time, it's getting hammered. And SLV has an 84 million ounce short position, or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So I guess it's shares. So the shares are being driven down, which affects the price, but yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the COMEX. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. And again, think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable. And our debt is rapidly approaching 130% debt to GDP, where other than Japan, no one's ever come back from that. And, the difference with Japan is that, they're not the world reserve currency. They have a budget surplus, and their debt not only is contained with yield curve control, it's mostly owned by the hedge funds, the government, and the people. And so they can get away with it. We can't.
Now let's step back and look at what all this means. The system we're watching unravel was never built to last. The COMEX, the LBMA, these aren't free markets. They're control mechanisms. They exist to manage perception, not to facilitate true price discovery. The paper market in gold and silver is hundreds of times larger than the physical supply that actually exists. It's the biggest fractional reserve scheme on Earth, and the only reason it's lasted this long is because people believe it will. But belief systems can only stretch so far before reality kicks in. And reality is here. Central banks know it. Sovereign wealth funds know it. The BRICS nations definitely know it. That's why you're seeing a fundamental shift from Western paper to Eastern metal. China isn't buying US treasuries anymore. They're dumping them, stealthily month after month, and using those dollars to buy gold. Russia's been offloading US assets for years, stockpiling metal. The Saudis are quietly rethinking their relationship with the petrodollar. Even smaller nations like the UAE and Kazakhstan are diversifying away from the greenback. What does that tell you? It tells you the dollar's monopoly is cracking. The West used to own gold. Now the East owns it. The US and Europe have been draining their vaults to settle foreign delivery obligations, while Asia keeps taking delivery and storing it permanently. Gold is migrating eastward, just like manufacturing did decades ago. And the consequences of that shift are about to hit the Western financial system like a freight train. Remember, in 2020, the US exported more gold than it mined for the first time in history. We weren't selling gold, we were liquidating our reserves to meet demand. That's how you know confidence is being lost from the inside. Now combine that with what we just talked about, massive physical deliveries on COMEX, record central bank buying, and Wall Street suddenly pivoting into gold. And what do you get? The slow-motion collapse of the paper gold market. And silver? Silver's story is even more extreme. Industrial demand is surging thanks to solar, EVs, and electronics. The world uses more silver than it mines every single year. Global above-ground inventories are shrinking, yet somehow the price of silver is still set by a leveraged futures market in New York that trades more ounces on paper every week than exist on Earth. That's the definition of unsustainable. So when I look at what happened last week, the engineered price smash, followed by record physical deliveries and major bank accumulation, it's not a mystery. It's a symptom of a system in stress. The insiders are repositioning for a reset. And this reset isn't just about price, it's about trust. The dollar's credibility is gone. The treasury market, the deepest bond market on the planet, is cracking under its own weight. Inflation isn't going away. It's embedded now. And every time the Fed tries to fight inflation, it ends up triggering another crisis that requires even more printing. So what happens next? First, more volatility. Expect more of these sudden, overnight sell-offs followed by rapid rebounds. They're going to become the new normal because the big players are using them to accumulate physical while controlling sentiment. They need the public to stay scared, to keep believing gold and silver are too volatile to own. Second, expect more mainstream shifts. You're going to see more big-name institutions start publicly endorsing gold as a portfolio anchor. They'll talk about it as a hedge or a diversifier, but behind the scenes, they'll be positioning for the next monetary regime. Third, and this one's coming faster than most think, expect cracks in delivery systems. The LBMA and COMEX will keep reporting ample supply, but behind closed doors, premiums will rise, wait times will lengthen, and allocated metal will mysteriously roll over month after month. That's when you'll know the physical squeeze is real. And finally, when that squeeze reaches critical mass, you'll see what I've been predicting for years. The moment when paper loses control of price. That's when spot prices will disconnect from futures prices, when buyers will pay whatever it takes to get physical metal, and when the entire financial world will suddenly rediscover gold. Now, before that happens, expect the media to play its part. They'll mock gold bugs. They'll call silver dead money. They'll say, this time is different. But remember, they said the same thing in the late 70s, right before gold went from $200 to $850 in 2 years. They said the same thing before the 2011 run-up to $1,900. History doesn't repeat, but it sure rhymes. So what can you do? Stay patient. Stay allocated. Don't get shaken out by engineered volatility. The people who make real wealth in these transitions are the ones who hold through the storm. The ones who sell because of fear, they hand their wealth to the patient. Think about what this really means. You've got major commercial banks, the same ones that used to short gold, now advocating 20% to 25% allocations. You've got sovereign nations taking delivery while pretending not to. You've got the East draining Western vaults. And you've got retail investors still asleep at the wheel, buying index funds and crypto memes, thinking they're diversified. By the time the mainstream realizes what's happening, it'll be too late. Physical premiums will explode, availability will vanish, and the same people who mocked gold will be begging to buy at any price. That's the nature of transitions. They happen slowly and then all at once. So here we are, Monday again, another mystery pullback, another scare tactic, another round of headlines about gold selling off. But if you look beneath the surface, you can see the truth. The smart money isn't selling, it's taking delivery. You want to know what real accumulation looks like? It looks exactly like this. Panic in the paper market, quiet confidence in the physical one. So stay calm, stay focused, and remember, every engineered dip is another chance to get your hands on the one form of money that's outlasted every empire, every currency, every paper promise ever made. Gold doesn't need a CEO. Silver doesn't need a bailout. They just sit there quietly, holding their value while the world burns around them. And if you understand that, if you really get it, then you already know how this story ends.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.